Hello, and welcome to Explain the Charts, your go-to channel for detailed technical analysis. Today is November 20th, 2025, and we are diving deep into the Nasdaq 100 ETF, symbol QQQ. There is a huge amount of news driving the market today, so let's start there before we get to the charts. The biggest story by far is NVIDIA's phenomenal earnings report, which absolutely crushed expectations. This has sent Nasdaq futures soaring in the pre-market, with NVIDIA's stock itself jumping over 5%. The strong guidance from NVIDIA has single-handedly rekindled bullish sentiment in the entire AI and tech sector, causing a ripple effect across global markets, with stocks like TSMC and Samsung rallying in Asia. On the domestic front, we also saw a positive report from Walmart, which raised its full-year forecast, suggesting the consumer remains relatively strong heading into the holidays. However, it's not all clear skies, as there are significant headwinds to consider. Hopes for a December interest rate cut from the Federal Reserve have been fading fast. Minutes from the Fed's last meeting revealed deep divisions among policymakers, with many officials believing it's appropriate to keep rates steady for the rest of 2025. Adding to the uncertainty, the delayed September jobs report is finally due today, which will give us a crucial, albeit dated, look at the state of the labor market. There are also growing concerns of a no-hire, start-to-fire labor market, with layoff announcements picking up, which this report will not yet reflect. So we have a classic battleground, a massive bullish catalyst from tech earnings clashing with macroeconomic uncertainty. Now, let's see how this is all reflected in the price action on the daily chart for QQQ. Looking at the big picture, we can see a very strong uptrend for most of the second half of the year, after a significant and volatile sell-off back in early April. The market put in a major peak just a few weeks ago at the end of October, reaching an all-time high of around the $637 mark. Following that peak, we saw a sharp but orderly pullback throughout the first half of November. This correction brought the price down to a key support area around $596, which was tested just 2 days ago. That $596 to $600 zone is now our most immediate and critical short-term support level to watch. Yesterday's candle shows a bounce from that level, closing back near $600, indicating buyers are stepping in to defend it. The primary resistance, of course, remains that all-time high around $637. A confirmed break above that level would signal a continuation of the powerful long-term uptrend. If we do break below the $596 support, the next level to watch would be the early October low near $589. Beneath that, we have a more significant support zone from the late August consolidation, right around $565 to $570. Let's zoom in on the daily chart to get a clearer view of this recent action since the beginning of October. Here you can clearly see the powerful rally through October, the peak at $637 and the subsequent 2-week decline. The selling pressure was quite consistent, as you can see from the series of red candles. However, the volume during the pullback was not exceptionally high, suggesting it was more of a correction than the start of a new bear market. The large bearish candle on November 18th is what brought us down to that $596 support. Yesterday's bullish reversal candle, combined with today's pre-market strength from the NVIDIA news, strongly suggests that a short-term bottom may be in place. The immediate challenge for bulls is to reclaim the levels lost over the past few weeks, starting with the 608 to 610 area, which was the breakdown point. Switching to the hourly chart from late October, we can analyze the structure of that initial drop from the peak. Here we can see a clear series of lower highs and lower lows, which is the definition of a short-term downtrend. Notice the sharp drops on November 4th and November 6th. These moves show significant selling pressure as sentiment shifted due to fears about the Fed's future path on interest rates. Understanding this structure is key, as bulls will now need to break this pattern of lower highs to confirm a reversal. Now, for the most recent price action, let's look at the 15-minute chart, which covers the last few days. We can see the intense selling pressure on November 18th, which took QQQ from around 602 down below 592 in the pre-market before recovering. The price then chopped around and eventually established a low, followed by a grind back up. Yesterday, on November 19th, the market showed strength, pushing up from the 597 level and closing the session strong, right around that 600 psychological level. This price action set the stage perfectly for today's bullish catalyst. Given the pre-market futures, we can expect a significant gap up at the open today. This gap will likely take us immediately above short-term resistance, putting the 608 to 610 zone in play right from the opening bell. So let's go back to the daily chart to recap and discuss what to look for next. To summarize, our key price levels are clear. Immediate support is at $596 to $600. Major long-term resistance is the all-time high around 637. Intermediate resistance levels to watch on the way up are 610, 620, and 625. Now for our potential scenarios. The bullish case, which I believe has about a 70% probability in the short term, is that the NVDA news provides enough momentum to propel the market higher. In this scenario, QQQ gaps up today, holds its gains, and closes strong above 610. If the jobs report comes in favorably, meaning it doesn't suggest an overheating economy, this could fuel a move back towards the 625 area and potentially a retest of the all-time high before the end of the year. The bearish case, with about a 30% probability, involves the market fading today's opening gap. This would happen if the positive earnings news is overshadowed by a surprisingly hot jobs report, which would increase fears of more Fed tightening. If the market reverses and breaks below the critical 596 support level on a closing basis, it would be a very negative sign. This could trigger a deeper correction down to the 589 or even the 570 support zone. The two main things to watch are, first, whether today's gap up holds throughout the trading session on high volume. And second, the market's reaction to the September jobs report when it is released. The market's interpretation of that data will be paramount in setting the direction for the coming days. Always remember to manage your risk, especially during volatile news-driven periods like this. And finally, a brief disclaimer. This video is for informational and educational purposes only and should not be considered financial advice. Trading and investing involve risk, and you should always conduct your own research and consult with a financial professional before making any investment decisions. Thanks for watching Explain the Charts.